Hey guys, Ben Sykes, First Coast Mortgage Alliance. It is Friday, May 23rd. We're headed into the Memorial Day weekend. I wanted to go ahead and get on here. I know, obviously, hope that you get to spend some time with the family this weekend, enjoying some time off, but also know that many of you are going to be out showing properties, hopefully going under contract on properties and all of that jazz. So, wanted to get you just kind of a market update, some of the things that we're seeing this week and some of the things that have been going on. So I'm going to pull this up, and really where I want to start is kind of this week. It's been a little bit volatile from day to day, as you can see, but overall, the landscape is relatively unchanged over this week. It's a big news week, which is always interesting. And I think that obviously plays into the volatility a little bit. On Tuesday, we got China's rate decision. China continues to move their interest rates down. Which is an interesting development. Certainly something we want to continue to keep an eye on. China, just like America, has its own underlying economic issues, and tariffs do play a role in that for China. It is a huge part of their economy. We are their largest consumer. And so the reality is, until this tariff conversation stops or ceases, we're going to continue to see movement based on anything China related, tariff related. And so it's certainly something we're going to want to continue to keep track of. The 20-year bond auction was soft. Essentially, we were sitting at about 4.81. That came in over 5%. And what does that mean? So when bond yields move up, that's going to push interest rates up. And one of the reason we're seeing bonds move up is further fear of inflation. That's just one of the factors. Essentially, if if consumers are going to put their money in the American dollar, what is their expectation that that dollar doesn't get inflated? I think trying to create an analogy here, it's if I give you 100 expecting 105 back, but then you start printing money, and now my 105 is worth the 105 I was expecting is worth less than the 100 I invested. That becomes an issue. And so that's where we see these higher yield spreads start to come into factor. Initial jobless claims actually came in lower than expected. This is a positive sign. One of the things that we were fearful of as this kind of goes alongside continued jobless claims, which stayed very flat. Essentially, what that means is we're not at the moment seeing huge layoffs. What we are seeing is people who are not employed right now, people who are in the market for employment, are maybe having a little bit of a hard time finding a new job. And I think, again, a lot of this plays into some of the economic conversation that we're having, whether it's tariffs or housing. There's just a lot going on right now that is going to take a little bit of time to play itself out. I think we're going to get a better idea of where the economy is 60 to 120 days from now. And so we want to continue to keep an eye on all of these things, but we also don't want to get too far ahead of our skis. Bond market closes early today. Honestly, that might be a positive as we kind of ramped up this morning and then have kind of filtered back. We're sitting 8 basis points up, which is still a positive day. But I mean, we were at a point today, we were over 20 basis points up. And so one interesting dynamic to follow this Friday will be Fed Chair Powell. He's going to be speaking this afternoon at 2:45 after the bond market closes. And so we won't really know what the reaction is to some of what he's saying until Tuesday. And one of the funny things is when you give economists that much time to speculate about what's being said, where markets are going to be closed today when he speaks, Saturday, Sunday, Monday, holiday off. Obviously, markets will open back up on Tuesday, and it will be very interesting to see some of those developments. The only other thing I kind of want to touch on is interest rates. Yeah, they're high right now. It just is what it is. I think one of the things we need to stop focusing on is rates, timing the market. Let's be strategic with our buyers, understanding what it is that they need. One thing that I would communicate to you guys, if you've gotten this far in the video, fantastic. Something to hold in your back pocket right now is we are very much utilizing a 1.0 buy down right now, which is where if somebody is really held up by interest rates. If that's the real reason, if you said, if they're saying, man, interest rates are 6.75% right now, and until interest rates get under 6%, I'm just not comfortable buying. Okay. Well, what if I told you right now I could get you under 6% interest at no cost to your buyer? Okay. One of those tools is a 1.0 buy down. And as the lender, as a broker, we have a little bit of flexibility in our pricing. And it's one of the things that we're looking at doing for consumers where we can take market rate and just come down 1%. And that 1.0 buy down gets them a 1% interest rate buy down for the next year. I think a lot of us are in similar understanding that it's very likely that we see rates come down within the next year or so. How far they come down, I don't know, but at least that 1.0 buy down will give them a little bit of breathing room over this next year. And ultimately, at the end of the day, we want to ensure that they're able to saddle the payment one way or another, because the reality is it could be 18 months until we refi. It could be 2 years until we refi. And so we want to keep all of those things in our understanding of what we're trying to help our client accomplish. But if we could get that interest rate down on the front end, would that make your buyers more likely to jump? So something to keep in your back pocket. Conforming 30-year Poly right now has that rate sitting just under 7% at 6.94. We could certainly get a little lower than that. 15-year conforming 6.75, again, could be under that. Jumbo is one of the spaces where we're able to get extremely aggressive. We can definitely get under 6.72 on a jumbo deal. Some of that's going to depend on what is the client, what is their income like, what is their down payment structured like, and then FHA sitting at about 6.65. Again, I think I followed this up last week. We were sitting relatively the same spot last week, and we were locking clients in at 6.2, 6.3 at that time. And so FHA is one of those ones where in the broker space we see a little bit of a larger discrepancy between a retail lender and what we're able to do with some of our wholesale and correspondent lenders. So if you have any questions, if you need anything this weekend, please don't hesitate to reach out. I'm available. My hours are the same as yours. I hope you guys have a wonderful weekend, a happy Memorial Day, and I'll see you next Friday.